Hello, my name is John David Powell, and from the television studios of the Jack J. Valenti School of Communication on the campus of the University of Houston, this is Discovery. The presidential elections are about 2 weeks away, but it seems the top issue on the minds of the American people these days is not so much presidential politics as it is their personal pocketbooks. The present financial crisis and how public policy contributed is the subject we'll look at today with Jim Granato, Director of the University of Houston Center for Public Policy and Associate Professor in the Department of Political Science. Professor Granato received his Ph.D. from Duke University in 1991 and became the Director of the Center for Public Policy 2 years ago. He also has served as the Political Science Program Director and Visiting Scientist at the National Science Foundation. His recently published book, The Role of Policymakers in Business Cycle Fluctuations, published by Cambridge University Press, looks at how monetary policy can stabilize business cycles. And it's a pleasure to have you here. I wish we were talking about things more pleasant than we are right now, but a year ago, I'm going to come up to you and say, Jim, we're facing a financial meltdown here. But at the same time, I'm just as happy as a clam because I'm paying $3 a gallon for gasoline. Would you look at me like maybe they should put me away somewhere, or did you foresee this?
I did not. What I look at typically is whether or not the Federal Reserve is stabilizing inflation. So that was always, and there are incredible benefits to stabilizing inflation. What we had here was a set of rules and procedures in the market, in some sense supported by the government, that created this meltdown in the mortgage market. And it has nothing whatsoever to do with inflation stabilization. So I would have said, based on what I look at, I thought we were doing quite well. But obviously that wouldn't have been correct.
All right, I said let's do a little mortgage crisis 101 or financial crisis 101. What got us to where, well, first of all, where are we today? What is our situation and what got us here?
Well, the situation is dire, but the response, particularly by the Federal Reserve, has been correct. The Federal Reserve is trying to do what's meant to do. When it was created in 1913, it was supposed to be the lender of last resort. And what it's doing right now is trying to unlock the clog in the credit market. They're trying to open up credit so firms that are low risk entities which are prospering don't get caught up in this inability to get funds. So what the Fed's doing right now is it's doing things like buying commercial paper. These are loans to businesses that are just based on reputation alone, basically. That's something that's never been done before, and it's meant to give firms like GE or whoever that are good risks money so they can continue to make payroll and do the things they need to do to sustain themselves.
So this is a situation where the government maybe should have been watching a little more carefully, but since it didn't, now it's going to have to come in and clean up the mess it created, or?
Yeah, I mean, there's two things going on. I mean, it used to be that mortgages, let's talk about the market first. Mortgages were traditionally done by a bank. And over time, financial intermediaries start taking these mortgages and bundling them up. We call them mortgage pools. And the payments that you made to the bank or to this pool was a stream of income that these investors got. Now, the ratings for these mortgage pools were to say the least, not very, they were not sound. I mean, risky investments were giving pretty high ratings. In addition, there was political pressure to expand home ownership, and we'll get to that in a second. But the bottom line was lending practices over time, like in the 30s, 40s, and 50s, you had to put as much as 40% down to allay the risk. By the 1990s and part of 2000, people weren't having to put any money down. So the risk of default rose, and because you're now lending to people that couldn't pay back. And if housing prices would not continue to go up, defaults would start to increase, and that's what happened. Housing prices started to level and started to fall, and these people that were getting these mortgages basically without having to put anything down, put all the risk onto these financial intermediaries who started to tank.
So logic tells us that's not a good thing, but it happened anyway because of
the federal government.
Political pressure?
Oh, yes. Let's go back to the 1930s. I mean, a lot of this traces back to legislation in the 30s. I mean, mortgage interest is we wanted to promote home ownership. It was thought to be a good idea. We, meaning the federal government, thought promoting home ownership was a good idea. So you go back to the 1930s, and it created the Fannie Mae, the Federal National Mortgage Association. And what they did was they kind of shored up the market. There are many agencies created during the Depression to try to shore up markets, whether it's aeronautics, we had the CAB, Securities and Exchange Commission, to help stock market and financial intermediaries. The housing market, you had Fannie Mae, and it was created in 1938. And it was meant to provide some type of stability in the market. In addition, we also had favorable tax treatment for homeowners, like mortgage interest deduction. So that was the beginning of having this entity. Now, this entity wasn't small. It had up to 50% of all mortgages were backed by Fannie Mae. In addition, if you look just at this year alone, by January, Fannie Mae was involved with over 70% of all mortgages. So they had their hands all over this. Now, Fannie Mae's sitting there like that. Fannie Mae also is privately owned now. It's been privately owned since the 60s. So that means that the profits are taken by private individuals. But because Fannie Mae was associated with the government, you now have the perception that it's still backed by the government.
Right. And
what does that create? It creates something called moral hazard. That is, people take risks that they otherwise wouldn't. And the risk here was the subprime lending crisis, starting to lend money to people that probably didn't have the right credit profile to promote, guarantee of not having a default or risking more defaults.
All right, let's get to your public policy. What role did public policy play in this?
Well, in terms of policy, we had something called the Community Reinvestment Act of 1977. Now, ostensibly, that act was done to stop what we call redlining, that is, discrimination in mortgage lending. It's particularly targeted towards black individuals. 1977 Act was meant to stop that. Follow-up in the early 80s and mid-80s, even late 80s, it was not thought to be a very, very vigorously enforced act. So in 1995, the Treasury Department expanded enforcement. Now, what's the enforcement mechanism here? If banks aren't following certain guidelines, what happens is they're not allowed to merge or consolidate, do things they need to do to make themselves better off financially. So that was the stick, so to speak.
Okay.
But the bottom line was the pressure was put on to make more and more loans to people in these areas, regardless of redlining. And that meant lessening demands for collateral and things like that.
This goes back to the political pressure
yes,
that you were talking
yes.
about? Yeah.
But as a public policy, you had a couple things going on. One is you have a moral hazard structure. So the way they structured Fannie Mae created a situation where you have risky lending. You have these acts that are promoting subprime lending. And now you've got a situation in which all this, you've got these intermediaries which sell these bundles, which have a few of these quote-unquote unbacked mortgages that are being sold around. They're not rated well. You've got Fannie Mae, which is willing to support this, and they're under pressure to give money to people that can't pay it back. And as soon as housing prices start to level off, you start seeing these defaults.
So this is an example of the old saying, buying a pig in a poke.
Yes.
And there's lots of pigs in this poke.
Yes. Yes.
All right. So what kind of public policy do you see that's going to bring us out of this? Or is this going to happen soon? In
the short term, follow some of the things that the Fed is doing. I mean, what the Fed is doing is exactly right. Just unclog the credit markets. So make sure there's sufficient funds there for firms that are good risks to continue to go about their business, because a lot of firms are doing quite well. I mean, the interesting thing about this is unemployment and a lot of other indicators, macro indicators, are still pretty good historically. We're in a looks like a recession now. It sure looks like it to me. The issue, though, is we're nowhere near what we were in, say, 1980 or 1981 when unemployment was like at 10%. So we still have relatively low unemployment. We've had sustained growth basically since 1982. And even though growth is lower, it's below average, it's possible we may just have a couple quarters where growth is negative. But we could snap out of it quickly, provided the Fed's allowed to continue to fund businesses that need the money, and the federal government can step in with various types of stimulus packages. That's the short-term thing we need to do. Long-term, you've got to deal with this moral hazard issue. So you've got to restructure the way we have lending practices done in the United States. That means Fannie Mae and Freddie Mac, these entities, they have to be dealt with in a very, very aggressive way. So my guess is what they'll eventually do is appoint a commission, pick someone like Paul Volcker, who has a stellar reputation and knows these issues, come up with a set of recommendations, and then have those recommendations acted on. Now that's a little bit difficult because Congress has their own mindset about certain things, but you want to get a commission to start to look into this and say, here's the things you need to do to restructure markets.
Every now and then we hear the term churning.
Yes.
What is that?
Well, churning is you want to we are a profit and loss system, and this is very important for people to understand. Bailing out entities can be a very dangerous thing to do. I mean, an example of that a lot of people discuss is the Chrysler bailout. Now, the problem is Chrysler got a guaranteed loan, and they paid it back. The problem is, who didn't get the loan that was already doing well? In addition, if Chrysler would have went under, and here's the churning part, if Chrysler would have went under, they have facilities, they have workers, there's unused capacity that could have been bought up by GM or Ford or Toyota or some other entity. And that meant that even though Chrysler itself would have ended, the churning of merging and all these other things would have allowed the capacity that Chrysler provided to be used by someone else. Okay. And this is not only just with business, it's also with jobs. It's a fact of life that about 21 million jobs are lost every year, just gone. Now, why is it that we don't have massive unemployment? The reason is because for all these jobs that are lost, there are many jobs, even more jobs created. So this is what's going on. We have a constantly changing economy. And when we have certain types of policies that try to bail out or stop this process of churning, we run the risk of preventing processes that create value for us all.
All right, we have an election in just a few days. How is this going to, this whole situation going to affect the election, or, you know?
In the short run, Senator Obama has done quite well. I mean, this has really helped him. I mean, John McCain was up after the Republican convention by 3 to 4 points. There's been about, I would say about, depending on what polls you look, but if you take average of them, he's up between 5 and 10 points. So there's been about an 8 to 10 point turnaround. And so in the short, the election's almost here, but it's definitely helped Senator Obama. And the reason why is because the incumbent party is the one that's been blamed for this. And that's typical. We usually see the incumbent party that holds the White House. Yeah. Economic maladies are usually attributed to the president, not to the Congress.
Right. Who had the greater role in this, the White House or Congress?
Well, if you look at the reforms that we tried to institute for, the Congress tried to institute for Fannie Mae, they were blocked internally. In terms of the president being able to take unilateral action against Fannie Mae, it could not, because Fannie Mae is a creature of Congress, so Congress had to act to do this. Now, we had both Republican and Democratic Congresses. We had the Republicans in Congress since 1994 and a Democratic Congress since 2006. So in that mix, I would put the onus on Congress, and the question is, which parties seem to be more wedded to Fannie Mae? And it appears...
And really, did it even start in 94? You know, it started prior to that.
Oh yeah, the lending practice started prior to that, but they really kicked in probably after 1995. But that was when we had a Republican Congress too. So the idea the Republicans didn't stop this from happening, or at least could have stopped it from happening early on. They did not do it. But when we knew it was getting worse, it was Democratic Congress that didn't stop put out the fire, so to speak.
Okay, crystal ball time. When do we get out of this? Is this going to be a short term? By short term, we're looking at 6 months, a year, a longer term, 2 years to get out of our financial situation?
I would say,
or even longer.
It's going to take at least 6 months. I mean, you have to let the money that's being lent out churn through the economy. So what the Fed is doing is correct. I think it's probably going to be less volatile 6 months from than it is now. But we're looking at people taking money out of the bank and just leaving it at home and putting it in places that don't support our deposit system. You need to get them back in. So you're looking at least 6 months for that psychology to change. It's very hard to gauge that. But the bottom line is, unlike the Great Depression where the Federal Reserve pulled money out of the economy when they needed it, the Federal Reserve is doing exactly the right thing right now. And it makes sense because the chair of the Federal Reserve is an expert on the Depression. Ben Bernanke knows what he needs to do here, and he's been acting very aggressively to make sure there's sufficient credit out there and taking unprecedented steps to make sure that there is credit out there. So I would say it's going to take about 6 months to filter through and start to slow down this decline. Okay,
one last question before we leave you. The role in the global economy. This is a global problem.
Yes, it is.
So, we can get our house in order, but what do we need from our friends around the world?
In fact, it's happening right now. There's a good deal of cooperation, coordination, which is, again, unprecedented. So everybody's got a stake in this game. And what they're doing, along with us, is they're loosening up markets. They're trying to make sure that sufficient funds are lent out so that enterprises can continue to, who are doing quite well, are not caught up in the inability to get funds.
Okay, Jim Granato, thanks. Just a little short explanation of where we are and how we got here. And I'm not sure if we can still understand it all, but we'll get through it.
Yes.
We'll get through it. Thanks for being with us. I'm John David Powell, and thanks for being with us, and we'll see you next month.